Good morning, everyone. Thanks for joining today's employer training session. I'm Jeff George. This is Kelly Resnick.
Good morning.
We'll be guiding you through today's presentation, and we'll also have some other panelists join for different topics. Our goal today is to give you the information that you need to manage all of your TRSL responsibilities. So feel free to ask questions during the presentation. We have someone off camera that can respond to the questions in Zoom, and we'll be monitoring questions as well and can incorporate them into the training as needed. You can't stay with us the whole time, that's fine. We're recording this and we're going to post it on our website so you can watch it at your convenience. So let's go ahead and jump right in.
Okay.
So today we're going to talk about kind of the basics of TRSL. We're going to start with a discussion of EMIS, just what it is, how to get access to it. Then we're going to cover TRSL eligibility and how to get people enrolled in TRSL. We're going to cover ORP, the Optional Retirement Plan, monthly contribution and salary reporting, submitting that file to us each month and looking at your exceptions, certifying service credit, making corrections, and we're going to finish up with what is your responsibility during that retirement process.
Right.
So I said we're going to start with EMIS and how to get access to it. That corresponds to Index 0 and Index 1 in our procedures manual. So I think anytime we talk to a state agency audience, we have to kind of acknowledge that we know that you're fluent in lasers, but maybe not so much in TRSL. TRSL is kind of like a second language to many of y'all. Let's go through some of the key differences between TRSL and lasers.
Right.
So right off the bat, your agency number in TRSL is going to be different than your agency number in lasers, right? The employer contribution rate, that's going to probably be different than what it is for lasers. For us, you're going to be contributing at the same rate as K-12 employers. We operate on a fiscal year basis, July 1st to June 30th. Lasers operates on a calendar year basis. So that's another big difference.
Yeah.
And we don't interface with LeGov where lasers does.
Right.
So we know right off the bat, hey, there's a lot of differences.
Yeah.
Most of you are much more familiar with lasers than us. We just always kind of want to acknowledge that going into it. And TRSL is nothing to be scared of. We're here to help you with it.
Exactly.
We know that it is different for y'all.
Yeah.
So each employer has a dedicated liaison.
Right.
For state agencies, most of you guys' liaison is going to be Quincy as a JOFO. Her contact information is here on the screen. You can also go to our website under the employers tab. Find your TRSL liaison that way. You also see contact information for basically everybody else in employer services. So if you can't get a hold of Quincy, call any of us,
Yes.
and we'll be happy to help.
Right. That is our direct number.
So I mentioned briefly Index 0, Index 1 of our employer procedures manual. Let's just start with talking about our manual. What is it? Where is it? How do you get to it? What's in it?
Right. So if you go on our website under the Employers tab, the Procedures Manual can be linked that way. Like Jeff said, the first few indexes goes over a brief overview of TRSL and our, which is our website, and then our intranet site, which is our EMIS, and that's our Employer Membership Information site. You'll hear us refer to it as EMIS. The other 18 indexes, they go over every process and any procedure that you need to do as a requirement for reporting data to TRSL.
Yeah, and obviously we're not going to go over every index today. We're going to kind of highlight we think are the most applicable. But all that information, anything TRSL related, is really at your fingertips in that procedures manual. Each index has a contents on the left-hand column of every page. It's clickable. You can search the procedures manual, do a Control F, find, and if you're searching for a keyword, and you can do so. It's a great resource. If you're not already familiar with it, we'll let you know that it's there, and it's really a great tool.
And another side note that I want to add is our indexes are numbered, and then also our forms, which are located under our resource tab on our website. Those form numbers correlate to the index numbers. So if you're trying to fill out a form, for example, like Form 11, whatever, you can reference Index 11 to help you with those processes and filling out forms.
All right, so EMIS, our employer membership information site. This is really where you're going to go to do anything TRSL related.
Right.
View member records, submit corrections, you can submit files, run reports. How do they get to it?
Right. So again, on our website, when you go to TRSL.org, to the top right, you're going to see the Employer Access tab. You're going to click on that, and then you will enter your username and password to gain access to EMIS.
And on here, you'll see the Updates tab, all the different updates available, the Submit Files tab. We know that for a lot of state agencies, OSIP is going to be reporting your monthly salary files, and often sick leave files as well. But if they're not submitting it on your behalf, this is where you would go to submit files.
Right.
So let's take a little tour around EMIS.
Right.
I find that the best starting place is member summary.
Right.
So when they go to that member summary screen, what are they going to see?
Right. So again, in EMIS, under the Members tab, you can click on Member Summary. And when you click on that, you're going to see basically the history of every TRSL covered employment that member has had and their dates. This is where you're going to go to see if that member can retain membership. They must have at least 5 years of eligibility credit. And you're wanting to make sure that you're looking on the member summary screen at the eligibility line. That will be the third tan line. It's a slender bar, and it says service credit for eligibility.
Right. It's always going to be as of the most recent closed fiscal year.
Right. And just, yeah, like Jeff said, keep in mind that that eligibility credit is through the last fiscal year. So if they've worked any time in the current fiscal year, that may be making them eligible. And if you have questions, just reach out to us.
And then from member summary screen, you can then click on other links to go to other screens for whichever employee that you're viewing.
Right.
Account history. This is going to show you by fiscal year a breakdown of basically where they worked, how much they earned, their service credit for each year. This is a screen you're going to be looking at. We're going to get to later when we talk about corrections. You're always going to be looking at this screen to see what's already there before you change anything. The account history is exactly what it says. It's the history of the person's account year by year. And what if they want to look at not a closed year, but the current fiscal year?
Yes, the current fiscal year. Under the Members tab, you're going to go and click on the monthly salary contribution screen. And this is where it's going to say, show you everything that they've been reported for the each month of that year. And it's, if you look to the right of the money, you can see expectant codes. And those codes, a 3 generally is for, it's for active members. And a 3 means we are expecting money, and so money has to be reported in that month. A 4 would mean that you could report money, but you don't have to. And a 0 signifies that no money can be reported for that month.
Yeah, and this screen will be helpful a little bit later when we get in the contribution exception report.
Right.
Really, it tells you what we're expecting and what we received, and if those don't match, that's going to be an exception.
Right, and if somebody is going in a drop or retiring, you want to make sure that you're checking the screen to make sure all the money has been reported before you send that agency certification.
Right, and we'll get in that agency certification later when we talk about the retirement process. Yes. This is a great screen. Want to look at, okay, what's happening in current year? Well, here you go.
Yes.
So as you're navigating through EMIS, you're going to see these system codes. For state agencies, you're really just going to see 4 and 6. 4 is for TRSL regular plan, and 6 signifies that the person's an ORP participant. Right.
And we just talked about the member summary screen and the account history screen. If you start out as a member search under member summary, you just have to put in their social security number. But if you start a member search under the account history screen, you're going to have to put in either that system 4 code first.
Right. And if you're doing corrections, which we'll get into later, you're going to have to enter a system code.
Right.
Let's go over some of the reports that are available in EMIS. They're quite a few.
Mhm.
They're all listed here under the reports tab. We're going to highlight what we think are maybe some of the most helpful or maybe some of the employers aren't aware of.
Right.
So let's start with the enrolled, not reported. All these reports, the name really tells you exactly what
Yeah.
they are.
Yeah.
This is going to give you a list of your employees that we have an enrollment for, but you did not report earnings and contributions for a specific month.
Right.
So when you pull this record, again, you're going to know the system code, which for you guys is going to be 4.
Mhm.
And then you want to pull the month. Pull the month of the most recent salary file that you submitted.
Yes.
If you pull a month later than that, it's going to give you a list of every one of your employees because
Mhm.
they're all haven't been reported for a future month.
Right. Right.
So always pull the most recent month that we received the salary file for. And it's going to give you a list of people. Okay, these people are enrolled, but didn't report earnings or contributions for that month.
Right.
So that's an exception.
Mhm.
This is going to help you out determining who should be terminated most likely.
Right.
When do you think this would be most helpful
Yeah.
to pull?
Probably at the beginning of the fiscal year, you want to pull this to make sure that if there's someone that just didn't return or they've resigned or left and gone somewhere else, you pull this and it'll tell you who those people are that need to be terminated.
Yeah, especially with state agencies,
Exactly.
we find that it's going to be a 2-step process for you guys for terminating somebody. You have to terminate them in your system and in our system.
Yeah, and sometimes we realize again that when you terminate somebody, if they're not with TRSL, they're terminated in LaGov. It's a 1-step process, but with us, it is a 2-step process.
And then we've got a report that's kind of the opposite of that last report. This is the reported, not enrolled, where in this case, you are reporting earnings and contributions for somebody, but we haven't received enrollment for that person.
Right.
Now, this could be a timing issue where the 2R is in the mail. We haven't received it yet, or sometimes maybe you haven't even filled out the 2R, but this is going to identify people that you've reported earnings and contributions for without an enrollment.
Right.
And this, you don't have to pull by month, you just pull by the fiscal year. It's going to give you a list, like I said, of everybody that is reported, but not enrolled.
Right. And again, you want to be pulling this probably at the beginning of the fiscal year to make sure that you've caught everybody that needs to be enrolled.
Right. If you're reporting earnings and contributions for somebody, we expect them to be enrolled.
Yes.
So another important one is ending drop participation. This you can pull monthly. You select what month you want to look at in fiscal year, and it's going to tell you who's coming out of drop that month.
Right.
Now, why is it important to know when somebody is coming out of drop?
Right. So if someone is coming out of drop and they're going to continue working, you need to turn those contributions back on. And you want to do it in a timely manner. You don't want to, wait a couple of weeks, couple of months, and then you're realizing, oh, I didn't turn that person on. And then you got to go back and get contributions from that person.
Right. It's always difficult to have to ask them, hey, we didn't turn your contributions on. We need to get this money back from you. We don't. That's just a situation that nobody wants to be in.
Right. And just keep in mind, you can pull this report up to 3 months in advance.
Right. So if you want to pull this multiple times during the year, always stay a couple of months ahead of, when somebody's coming out. That's a good idea. We have another report, members eligible to retire. You can pull this one by fiscal year. So if you want to, for current fiscal year, okay, which of my employees are eligible to retire?
Right.
You can project it, a couple years in the future. The good thing about this, it's going to include anybody that's currently in drop or working after drop.
Right.
Those people, technically, they're eligible to retire today if they want to.
Right. And when you pull that report, if anybody is in drop, working after drop, their beginning drop date and ending drop date is going to be on that report. So you'll see their time frame for drop.
Right. So for state agencies, most of you guys don't have that many people in TRSL. So it might make more sense for you to just pull this report. Instead of pulling the ending drop participation report, we got to pull it monthly. Just pull this. Okay, this is everybody during this fiscal year that's in drop and when they're coming out, and kind of keep an eye on it that way.
Right, right.
In the last report, we're going to go over this ORP to TRSL election eligibility report. Up until a couple of years ago, when somebody was in ORP, they could not leave ORP.
Right, right.
They passed a law a couple of years ago that allowed groups of people to option to leave if they choose and join TRSL. I ran this other day for state agencies, and The results were so minute. I don't want to go into great detail about this because it's not really applicable to the state agencies right now. I don't think there's anybody with a 7-year window eligible. We've contacted these people. We've contacted employers to contact these people. This report's here if you want to pull it to see, hey, do I have anybody that's eligible to leave? But last time I pulled it, there really weren't anybody for state agencies.
Right.
So you mentioned earlier about how you get into EMIS, but not just any Joe Public can log into EMIS, right?
Right.
You gotta get access.
Yes, anybody can go on our website and look at information, but to get into EMIS and to look at personal employer and member information, you have to get access. And so you're going to fill out the Form 1, and that's located again under the Resources tab. It has to be the original form. It cannot be copies, faxes, scanned. Electronic signatures are a big thing. We do not accept electronic signatures at this time. So the form has to be filled out. And if you're checking anything other than inquiry, then the staff member that you're giving access to, they are going to have to sign this form as well. And then just as important as adding someone is taking someone away. And so if you need to delete access for someone, you will put it on this form as well.
Right, and this form has to be signed by the agency head or agency head designee. You see all these check boxes at the bottom with all the program names. But when you're filling this out, you're trying to figure out, okay, what all these programs do. Well, there's a description on the back of the form that tells what each program does. So we're not going to go through it and read all these to you, but they're there on the back of the form. So when you're filling it out, you match up the check boxes to the program on the back and say, okay, who needs access to the different tasks.
Right.
So we have a separate form that employers use to tell us who does what at their agency, who's going to be their contact. This form, like the last one, we have to receive the original. Same thing about no copies, faxes, electronic signatures. This one, though, does not have to be signed by the agency head. This has to be signed by an authorized signer. Every agency should have an agency head.
Right. You need that.
Right. So make sure you have an agency head and at minimum a retirement contact.
Right. Because your retirement contact, they're going to get those letters, retirement letters and things. And so we need to know who we can contact for those purposes.
Yeah, and you can add more people than that, or same people can have multiple duties.
Exactly.
But it helps us to know who to contact for different questions that come up.
Right, and so you're going to list that person's name, their position, their phone number and extension, and their email address. And then you're going to complete this form as often as you need to. If you're changing positions or changing phone numbers or changing email codes, whatever you do to update this, send it in as often as you need to, because this is how we contact you. And if it's changed, then we can't contact you.
So you might be wondering, okay, who do we currently have listed as for our contacts, and who has access to different programs in EMIS? Where can they go to see that?
Right. So under the Employers tab in EMIS, you can click on Employer Contacts. And when that screen comes up, in the first section, you're going to see your Employer Contacts is going to list everybody's name and position, their phone number, their email address, and things like that. Towards the bottom, you're going to see their permissions. Everybody is listed and what permissions they have. If you need to update the first part of that screen, then you'll send in the Form 1 EDC. And if you need to update the bottom part of that screen with the permissions, you'll do the Form 1.
Right. And as you said, it's important to keep this up to date. If somebody leaves, you got one person that's doing a task and that person leaves and nobody else has update permissions. That task just doesn't get done. Or we don't know who to contact to ask about something that we received. So you check this throughout the year, make sure that it's up to date.
Right.
Right. So let's talk about, who for state agencies, who can be enrolled, who's eligible for membership, and this corresponds to Index 2 of our procedures manual.
Right.
So when they're hiring someone, should they have a packet of documents that they fill out?
Yes, you should have a hiring packet, when you're onboarding someone or whatever. The first thing you're going to need is the Form 2TR. And when you, I'm sorry, 2R, that's another form we have. So election to retain membership, that's the Form 2R. And we have to receive the original copy of that. And then the next form is the forfeiture benefit form. Form 2 FRB. We don't need a copy of that. You keep the original with you, and if we ever need a copy, we'll let you know to send that to us. The next form is the Form 2SS. That's letting your employees know that the job is not covered under Social Security. We do need a copy of that, and you would keep the original. The last form we'll talk about is the Form 3. The Form 3 is the beneficiary form, and that needs to be the original. That is the employee or the member's responsibility to submit that form. So if you're helping the member to fill out that form or witness that form, make sure that you give that form back to them and have that them send the form in to us. It is a time-sensitive form. It's not valid until it reaches our office, no matter what their signature is.
Right. And for state agencies, with people that are retaining membership, they may already have a beneficiary on file. So that form, you give it to them, but they may or may not need to fill it out.
Right.
Right. So you mentioned the Form 2Rs. Let's take a look at it. Like I said, it's on our website under our forms link on our resources page. So when a state agency hires somebody, they're typically going to be eligible for lasers. Right. But if they have at least 5 years of eligibility credit in TRSL, they can retain membership in TRSL instead of joining lasers. To do that, they fill out this Form 2R. We need this within 60 days of that hire date. They got to send us the original form, original signatures. You see it right here on the form, and this black box on the top right. Original form, no copies, faxes, or scans accepted. That speaks for itself.
Yes, any form that we have that has that black box, it has to be the original. Not all of our forms have to be the original, but if they have that black box up there. And the other thing that we want to mention is go to our website and use the link on our website for all of our forms. They're updated periodically, so you want to make sure that you're using the most up-to-date forms.
Right. This would be a good time to talk about forms in general. Don't print out a stack of forms and just use that stack. Like I said, always go to the website, get the most recent, most current version. Forms change. If we get an old form that's out of date, might not be able to accept it. So just best practice, always go to the website and get the most current version of the form.
Right.
So we mentioned somebody can retain membership if they have 5 years of eligibility service credit in TRSL. Well, if they're part-time, seasonal, or temporary, they're going to fall under the 10-year rule for TRSL.
Right.
For state agencies, these are not going to be pre-K through 12 classroom teachers. If you're retaining membership in your part-time, seasonal, and temporary, you have to have 10 years.
Right.
So if we receive a 2R, I think there's a place on there where you can tell us if there's a box to check part-time. You can tell us how many hours they work. So if we get this and they're working 20 hours less per week and they don't have at least 10 years in TRSL, they're not going to be eligible.
Right.
Yep. We mentioned earlier about the changes to ORP where it allows certain groups of people to leave ORP and join TRSL. There's a group that has a 7-year window and a group that has a 60-day window. As I said, I ran a report for this last week, and for state agencies, didn't really find anybody applicable, with the 7-year window or the 60-day window. I don't want to go into great detail about that now, but if you have an ORP participant, if you do end up hiring one, and they want to leave ORP and join TRSL, contact us, and we'll go through that together and see if that's the case, if they can do it or not. There are flags that'll tell you if somebody is what window they're in. Like, for example, this person has a 7-year window.
Mhm.
You're gonna see the flag on the member summary screen telling you, when that window closes. For people who do have a 60-day window, when we receive ORP contributions for that person, their flag is going to change to yellow, saying they may be eligible. At that point, we send a letter both to the ORP participant and to the employer. So you'll know if you get a letter from us telling you, hey, this person might have a 60-day window.
Right.
Really, that's when you might want to call us.
Right. And you'll see when you pull someone up in EMIS under the member summary screen, you will see there's a big difference between a regular TRSL member and an ORP member. It's flagged all over.
And there is a form for that for somebody that wants to leave ORP and join TRSL. It's a form 2TR, again, on our website. Again, we've got to have the original form. There's a portion for the employer to fill out, portion for the member to fill out. Those windows have a hard deadline. So if you are in the situation where you have somebody that is wanting to leave and join TRSL, submit that document to us as soon as possible.
Right.
If it comes in after the window closes, then there's nothing that we can do.
Again, it's not when they sign the form, it's when we physically receive the form in the office.
So we have a question. I was asking, if an employee is moving to Lasers agency and does not have 5 years, what happens? Does their time roll over to Lasers? Well, they can they have a choice. They can refund. You can always refund. They can transfer the time to Lasers. It doesn't just roll over automatically. They have to tell us what they want to do with that.
Right. And they can leave it. And, when they get ready to retire, they can do something called a reciprocal, but that's all up to the member.
Right.
And if you have questions, reach out to us. And if you have specific questions about a specific member, just let us know.
Right. At this point, we're going to take a real quick break just to change out panelists. And we're going to have Jessica come talk to us about ORP. All right, welcome back. So Jessica Trosclair has joined us now to go over ORP, which corresponds to Index 16 of our procedures manual.
Good morning.
So we talked about ORP a little bit, but we didn't really go into exactly what it is. So what is the ORP?
So ORP stands for the Optional Retirement Plan. It's an alternative to System 4, to our regular TRSL plan, offered to academic and unclassified employees in the higher ed or the post-secondary arena. So it's not a plan that you all would be able to offer your new employees, but it is something that you may have employees who previously elected to join if they were in the higher ed arena and they retained membership and they're still a part of this retirement plan.
So you said this is an alternative to TRSL. Obviously, there has to be some differences between a regular defined benefit plan and ORP.
Definitely, big differences. So, TRSL is a defined benefit plan. So at the end of a person's career, they have made contributions over the course of that career, and then when they retire, their benefit is based on a formula. So it's actually more so in line with their salary and their service credit, not the contributions that they contributed while working. On the flip side, the ORP is specifically based on the contributions and the investment gains or losses that they have over the years in that account. We, the retirement system, are really just a flow-through agency of those funds. So we collect them from you as the employing agency. We then transfer them to the specific vendor, and then the participant kind of drives those investments into whichever particular plan they choose.
We had a question real quick. So did I hear correctly that no new hires can be enrolled in ORP?
That's right. So as a state agency, you're not able to offer the ORP to participants same way that you wouldn't normally offer TRSL. To initially elect to join, they have to be in a regular teacher's retirement position.
So you mentioned ORP is based on the contributions that really determines their payout. So they have choices of who their funds go to.
That's correct. Yeah. So they can pick between three different financial carriers or vendors. We have the same three that have been around since inception of the plan, but there's been some name changes along the way. It's Voya, TIAA, and Corebridge. Participants can change their carrier at any point in time. So either when they're newly hired or just at some point they're ready to move those funds, they can absolutely do so via the ORP election form, the Form 16.
So, as somebody was just asking, you can't put somebody directly into TRSL,
right?
Into ORP. How do you determine who's eligible?
Yeah, so the thing with ORP is that it is really an irrevocable election. The exception is Act 109, which is, I think, something that Jeff and Kelly recently touched on, the ability to leave the ORP in order to join teachers in that set window, the 7-year window or maybe a 60-day window now. For state agencies, what you're going to see is that a participant has already decided to join the plan. And if they're vested, they have 5 years or more, and they're electing to retain membership, then their contributions are going to continue with the ORP. They're not retaining membership, but switching those contributions to the regular system. They're going to stay in ORP. If they're not vested, meaning they're not eligible to retain membership, when they move from what would be a position eligible for the teacher's retirement system to a position that is then eligible for lasers, they would not contribute to their ORP. They would contribute to the retirement system that position belongs to. And if they have elected to retain membership, they're vested, they've retained, they're going to make contributions to their ORP account, even if they are part-time, seasonal, or temporary. That is different than the regular retirement system rules, but all employment, once they're in ORP, is reportable.
So we mentioned about the people that can leave in the past. Once you're in ORP, you were there forever.
Right.
So how does this work with my changes? What am I trying to say?
Kind of ties into what we've already discussed. And it's that, once someone makes this election and the Act 109 window has closed, then any changes are still going to require them to contribute to that ORP account. So again, if you have someone who started with you who was full-time, they drop down to a part-time position, they're still going to contribute to their ORP account. If they changed, they elected to join the ORP when they were with a university, they then retained membership and they've switched from one state agency to another, they could still contribute to their account. If they are in their window where they can elect to leave the ORP, they do have to be eligible for the teacher's retirement system. And Jeff, you guys may have already covered this, but they're going to retain, they have already retained membership, but they need to be in a full-time position to be eligible to leave the ORP in order to join TRSL.
All right, so if somebody is an ORP, the employer is sending us ORP contributions to us, but we don't keep them here, right?
Right. No, we certainly don't. We keep a portion of the employer contributions. So as you guys know, your employer contribution rate is comprised of 2 or 3 different pieces. There is what we call the transfer amount, which is similar to the normal cost. There is also the UAL payment portion. And then beginning in fiscal 2027, so this July, the employers will share a portion of the administrative expense rate. So those 3 pieces make up your total employer rate. And then again, what gets transferred to the participant's ORP account is the employer transfer rate. So that's 6.2%. And then the employee contributions less the admin fee. So currently that admin fee is 0.05%. It is fully payable by the participants. But again, starting next year, the participants and the employing agencies will split that. So the rates you see on the screen are for next year. 14.175% is what will be transferred of the total contributions to a participant account.
But there are limits to ORP contributions, right?
Yes. Yeah, there certainly are. The IRS places annual contribution limits on those contributing to an ORP account or this type of qualified plan. So for 2026, the limit is $72,000. You can kind of see a historical list here. We do post these on our website. Just something that's important to note is that this is based on both employee and employer contribution amounts. So we do look at the totals. We typically start looking at files around November. So we'll reach out to you and let you know that someone is approaching these limits. But we do ask that you monitor them if you're able to as well. Once a member or an employee hits this hits this limit, we would expect that you update your system so you're no longer reporting for them.
So a common question we get for ORP participants is, what do we do when somebody terminates?
Certainly. So very different than the regular retirement system. Again, because we're really just a flow-through agency of those transferable funds. We don't keep an employment history record on ORP participants to the same length that we do for regular members. So when someone's employment with you ends, whether they're just terminating to seek employment elsewhere or they are retiring, you really don't have to notify us in any way. You would just update your record, update your payroll system so they are no longer included on the file. You don't want to report zeros for them. And when the participant is ready to access the funds in their ORP account, they'll actually kick off that process with their carrier. So they'll reach out to them, they'll complete the distribution paperwork, and then if a termination date is required, we, the retirement system, would reach out to you at that point so that we can provide the necessary authorization to the carrier. So again, there's really nothing for you to do in terms of notifying the teacher's retirement system that the employment has ended. We would reach out to you if something was needed. And just a note, if a participant comes to you and states that their paperwork requires a signature from someone in your HR office or perhaps a plan administrator, so someone here at the retirement system, that's something that they can just kind of ignore. They can submit that paperwork with that portion being blank. That is a standard procedure. All of the carriers are used to this. They'll reach out to us through another channel.
All right. Just check to see if there are any questions in the queue. And there are not. So at this point, we're going to take about a 10-minute break and we'll come back and talk about monthly reporting.
Thanks.
Okay, welcome back, everyone. We're going to continue with Index 4. This is going to cover, your monthly contribution file, your reporting requirements, and then hearing exceptions and rejections that are resulting from that file.
Right.
So let's start with just a look at the employer contribution rates. For state agencies, you're contributing on the K-12 rate. So for 2026 current year, we see it's 20.95. For next year, 2027 fiscal year, we see it's dropping to 19.11. I want to note that there's a constitutional amendment on the ballot in May. And depending on how that election turns out, that amendment passes, that's going to take some money from some educational trust funds and apply it to TRSL's UAL, which would result in that employer contribution rate going down even further.
Right.
So, depending on how that turns out, the rate could change, could lower. If it does, obviously we'll, get that information out to you and restate the rate as soon as we can. Now, for state agencies, Uniform Payroll, they submit files on behalf of most, well, not most, but a lot of state agencies.
A lot of them, yes.
So if you are an agency that OSIP reports for, you're not submitting your own file. OSIP's
Right.
doing it for you.
Mm-hmm.
If OSIP is not reporting that for you, you have the option of submitting a file, or, if you only have a handful of employees, you can enter them manually.
Right.
And that's done through EMIS,
Mm-hmm.
through file submission or salary. Looks exactly what that's called in EMIS, but there's a way for you to just make some of these state agencies have like one or two employees.
Mm-hmm.
Doesn't make sense to generate a file. You can just go and manually enter that information.
Right.
So that is an option.
Mm-hmm.
Now, for the agencies that OSIP submits files for, they're also submitting that monthly payment,
Right.
right? So they're submitting the Form 4D. That's our payment voucher, telling us how to apply those contributions, whether it's member, employer, interest, sheltered, unsheltered, all that stuff is on that Form 4D.
Right. And just keep in mind that a 4D, that has the payment voucher, it has to be sent with any payment that is sent to us.
Right. And you can submit it multiple ways. You can mail it to us, you can fax it to us, or there's the email address on the top right-hand corner of the form. See this, how to submit, it's got the email right there. You can just, probably the easiest way is just to email it to that dedicated address. Now, we mentioned OSIP is going to submit that for that file. But if your agency is doing other corrections,
Right.
And we'll get into those types of corrections a little bit later, but if you're doing prior corrections or contribution corrections, those are creating other charges.
Right. And when your account gets out of balance and you're wanting to reconcile that account, OSIP is not going to do that for you. They just submit the salary file monthly. And if there is something that you need to pay in addition to that, then that's something that you're going to have to send the payment for with the 4D.
Right. So if you're not doing any corrections,
Great.
But if you are, we're expecting, and those corrections result in a charge, we're expecting payment from each individual agency along with the payment voucher.
Right.
So let's talk about like what contributions are paid on.
Right.
Right. So there's a definition of earnable compensation. This is going to be, compensation earned by the member during the full normal working time in a position that's TRSL eligible.
Right.
So we also call that actual earnings. But that's what those member and employer contributions are paid on. Those reports and payments are due by the 15th of each month. And as we said earlier, we operate on a fiscal year basis, July 1st to June 30th. So we expect contributions and earnings to be reported in the year that they were accrued.
Right.
So let's talk about some payments that are not earnable comp, and these are excluded in statute.
Right. So it's any payment in lieu of unused sick leave or annual leave, any lump sum payment for discontinuation of contractual service, for example, like a lump sum payout, like a severance packet, it has to be lump sum. Form 1099 payments for non-retirees without a primary employer, and then 1099 secondary employer payments. They're on a threshold for that. If an employee is not a TRSL retiree, then if they get an individual contract for $1,000 or less, or cumulative amounts of 1099 payments throughout the year that are $1,000 or less, and they exceed $15,000, if they don't exceed $15,000. So those things are not earnable comp.
All right, so let's go over a few more definitions. And for now, we're talking about that monthly salary file. So full-time earnings, that's a pretty important one.
Yeah. So full-time is anything that member could have been paid during the full normal working month. For example, if they're making, $3,000 a month, then the actual in the full-time would be $3,000. But if they're on leave without pay or dockage and they only get $2,000, you still want to make sure that full-time rate is $3,000.
Right. So that's always what they would have earned had they worked all possible days, all possible hours.
At 100% effort. Right. Yes. And if they're working part-time, then you want to calculate what that person could have earned working full-time, and that would be their full-time earnings for that month.
Right. And the actual should not be more than the full-time.
Right. Yeah.
So types of contributions, obviously there's sheltered versus unsheltered. And some of our screens in EMIS, it might not spell out sheltered or unsheltered, it might have a type. So type 30 is going to correspond to sheltered, and 10 is going to be unsheltered.
Right. So your sheltered people are going to be your active members only, and that includes members who are working after drop. We do get that question a lot. Anyone working after drop, their earnings are sheltered. Employees on workers' comp during that month, and they're using sick leave in conjunction with that workers' comp payment, then that is sheltered. We don't split up the month.
Right. And if you're on workers' comp, not using any type of leave, and they're paying contributions on third-party payments, that's going to be unsheltered. UCR payments would be unsheltered, and then employer contributions are unsheltered. So we mentioned that these monthly salary files that come in, if your file is rejected because it has an ORP participant on it, you need to take that person off, put them on your ORP file, and resubmit.
Right.
Now, if you're an agency where OSIP is submitting that file on your behalf, we're going to coordinate with them. Hey, we received this file, it was rejected, has an ORP participant. We're going to work that out with OSIP. They may then contact you, to keep you in the loop of what's going on.
Right.
So when we receive that monthly salary file, a couple of things are going to happen, right? If there's anything on the file that we're not expecting, or anything that's not on the file that we are expecting, that's going to be considered an exception. And if there are records on there that were just rejected, didn't cause the whole file to be rejected, but individual records were rejected for whatever reason, those are going to be those need to be cleared as well.
Yeah, it's going to be listed in a separate area, and that's your rejections. Yeah.
Right. So every time that a salary file comes in, you need to be looking at your exceptions and rejections.
Right.
So for agencies where OSIP is reporting this on your behalf, you might not know the exact date that they submit it, but we know they're due on the 15th. So I guess after the 15th of each month, make it a habit to look at these two reports and clear this. So we're going to go over these in more detail.
Right. And you want to be, like Jeff said, you want to be pulling these monthly and clearing these monthly. And if you have questions on any exceptions or how to, reconcile a rejection or what's going on, just give us a call and we'll work you through it.
So the contribution exception report, this is, like I said, you want to pull this monthly. We contact employers a lot about their exceptions report.
Yes, especially when it gets closer to close out.
Right. So let's talk about why that's so important.
Yes.
We part of our closeout process is making sure that all exceptions are good. We can't close our books for the fiscal year if any employer has exceptions.
Right.
So if we see throughout the year that an employer has exceptions that aren't being cleared, that kind of makes us nervous.
It does, yes.
So we don't know, are they aware of them? Do they need help fixing them? And with most state agencies, they don't have a lot of employees.
Right.
So we might only have one or two exceptions. But we're also, aware of the fact that, like we said earlier, you're not as familiar with TRSL as lasers. You might need help clearing these exceptions.
Right.
If you do, please contact us.
Yeah,
we can help
please
you.
Contact us. We're more than happy to help you. When you want to go pull this report, you're going to go into the Employers tab. You're going to click on Employer Contribution Charges, and the screen is going to pop up. And then there's two different ways that you can actually populate the report. You can either click on the red error message. You want to click on the error message or the error link, and it's in red. You want to click on the last month because it will pull every prior month into that report. You can also click in the navy blue field and click on Generate Report. Either way, it's going to submit it, populate the report.
Yeah, so you mentioned one way is just clicking on the most recent month that's posted. Click on the error link. If you don't have an error message, if they're all just say, like on this example, July is report, not error. If every month had report and no errors, that means you have no exceptions.
Right.
But if any month has an error link. Click on whatever the most recent month is, and that's going to generate your report.
Right. And then when you generate the report, this way, it's going to be in Social Security number order. And just keep in mind, if you have anyone in your agency that their Social Security number starts with 0 or zeros, those leading zeros are not going to appear on the report.
And you mentioned there was another way to pull a report that can make it more customized.
Yes. So you can also, in the navy blue field, you can, under report type, I like to pull it complete report, but you can pull it by individual report, such as enrolled not reported or reported not enrolled. And then I also like to click on exception message and then generate the report. Like Jeff said, you may not have very many messages, but if you have, very many exceptions, but if you do have a lot, it helps to sort it by exception message so you can clear them in groups.
And let's go back to what we talked about at the beginning, some of those reports available in EMIS other than the exception report. We had the enrolled not reported and reported not enrolled. Those are really subsets of the contribution exception report.
Yeah, exactly.
If you stay on top of those two reports, typically we see with employers about 80% of their exceptions are due to enrolled not reported or reported not enrolled.
Yeah.
So if you're working that during the year, you shouldn't have very many exceptions.
Exactly.
So this is just an example of an exception report. The top right-hand corner is going to tell you how many exceptions there are. In this example, there's 53. It's telling you sorted by Social Security number. Obviously, in this setting, we can't display names and socials, but when you pull this report for yourself, it's going to show you their name and social. It's going to show you the reporting period. That's the month that has the exception. It's going to tell you, the details. Okay, this person, this first one, their status date, the reporting period. This one actually has multiple, October, November, and December are all exceptions. It's going to tell you the contribution type, the actual earnings, the contributions, the full-time earnings, and then that last column, the exception message, which is telling you what the exception is. So for this first one, October, reported not enrolled. So we don't have an enrollment for that corresponds to October, but we did receive earnings. Contribution unreasonable. So the member contribution rate is 8%. If the contributions are not 8% of the actual earnings, it's a contribution unreasonable. This person also for November and December still reported not enrolled. So we're receiving contributions for this person without an enrollment.
Right.
And if you go down the list, contribution unreasonable, reported not enrolled, that exception message is going to tell you what the exception is. And then from there, you can figure out what you need to do to
clear it.
And these contribution exception reports are dynamic.
Right.
So as you clear them, if you were to run this report again, the person wouldn't be on there.
Right. So as you clear exceptions, they do clear off and they go away.
Now, rejections, on the other hand, don't.
No, they don't clear away. They keep a running record year after year after year. So again, if you want to look at your rejections, you're going to go just like you did to pull the exceptions report. And then if you have any rejections at the top of that screen, it's going to show a box that says show rejections. If you don't have any rejections, that box is not going to be there. If you click on that box and then scroll to the bottom of the page, your rejections, if you have any, will be listed in calendar year order.
Yeah, so this is like a close-up of somebody's rejections. One to really look out for, this last one, this transaction already received. That means somebody was on your salary file more than once.
Right.
So in that case, we're going to accept the first instance of it being on your report, and any times it's on your report after that, it's just going to be rejected.
Right.
Negative money, that's another big one.
It is. So if our system cannot handle negative amounts, if you've reported too much money in 1 month and you're trying to correct it by putting in a negative amount the following month, you're not going to be able to do it that way, and that is going to be rejected on your rejections. You just have to go in and correct that month that you had too much money, and we're going to go into that in just a second.
Now, you might have some rejections with all zeros. So 0 actual earnings, no contributions, 0 full-time earnings. These may or may not require any action. If they require any action, they'll also be on your contribution exception report. If they're on your rejections, but not on your contribution exception report, there's really nothing to do.
Nothing you can do.
You're trying to tell us, we paid this person no money, no contributions, and if we don't have an enrollment for that person, we're not expecting anything anyway.
Right. And so there's no reason to reconcile a zero.
Right. So let's fast forward. You've submitted your monthly file, or OSIP has submitted on your behalf. You're ready to, you pulled your exception report, and now you're ready to start clearing them.
Right. So there's 3 different ways you can clear your exceptions. You're going to go under the Updates tab, and you're either going to use the contribution correction, do an enrollment, but not online. I don't think you have that. You would do the 2R and then terminations.
So contribution correction is also known as a CCR. This is when you need to change what was reported to us for a certain month. You can add, edit, delete. What types of exceptions would you use this for?
Right. So if you've got someone who was enrolled, not reported, and you need to go back and add that person, you didn't have them on the salary file for that month, you can click on add, and then you're going to type in the amount, and then you're going to click add again. If you have someone whose earnings were incorrect or contributions and unreasonable, you can go under edit. You're going to retype the earnings again, and then you can hit replace, and that's going to update those earnings. If you have someone that you accidentally submitted as unsheltered and they should have been sheltered, you can go in and delete those earnings for that month and then add those back. And as soon as you add them back, the system is going to automatically code them with the correct contribution type.
All right, so we're just showing one screenshot here, but in Index 4 of our procedures manual, there's a whole section regarding these CCRs.
Yeah.
Shows you exactly how to do add, edit, delete, step by step with examples.
Yeah, it has screenshots of, like Jeff said, step by step. It's screenshots of EMIS walking you through exactly how to do each one of these processes.
Now, say you looked at your exceptions, started clearing them, you started doing these CCRs to clear them, and you want to say, okay, is there a record of what I did, or why does somebody's record not match what was reported on their salary file?
Yeah, just keep in mind, anything that you do in our system, it's going to keep a running record of it.
Right, so to see a record of the contribution correction submitted, go to that employers tab, like monthly correction journal, and there you can select it by month and year. You're selecting the month that was corrected, not the month that you actually did the correction.
Right, right. So you're looking, even though you may have done the correction for October, but maybe you did it in January, you're looking for the month of October that you actually corrected. And it'll be the actual month and the actual year.
Right, so this is permanent as well. You can go back historically and look and see, for years past.
Yes.
All the CCRs that have been done for your agency, who did them, what date they were done on, what the figures were changed to.
This is helpful. Like if you're trying to reconcile past months that are out of balance, and you can go and pull this and to see, what those charges were, what those credits were for those previous months that you're trying to reconcile.
Right, because once you do a CCR, now the figures aren't going to match that salary file anymore.
Right. So OSIP may have sent your salary file, everything's zeroed out, you go in and do some changes. Now those prior months that you did changes for are out of balance, and that is up to you to send in those payments or take those credits to reconcile those months. And remember to send a 4D with any payment that you remit.
So another way to clear exceptions is terminations. This seems pretty straightforward. If somebody is no longer working for you, they should be terminated.
Right.
And like we mentioned earlier, for most state agencies, that's a 2-step process because they terminate them, in their system or in the Gov. You still got to terminate them in TRSL.
Right. So when you go in to terminate someone, you go into the Updates tab, click on Terminations, and then you're going to enter the member's Social Security number, and then you're going to click on Edit, and then you're going to have to enter their termination date. Make sure that is their last day of work or official leave. If they resign like months later and they didn't work, you just want to back that date up to where it was their last day of work. The other thing you want to do is make sure that you're entering the correct months of contract, either on that 2R or during termination, because our system does use those dates and months of contract to estimate service credit, which we'll talk about in a minute.
Right. We mentioned the other way to clear an exception is an enrollment. Which, as you said, that's for state agencies, that's typically be a Form 2R.
Yes, typically.
It's important to get those to us within 60 days of their date of hire. Outside of that, there's another wrinkle we got to go through. But staying on top of enrollments and terminations, if you do that, your exceptions should be really, really low, really manageable. And then it's just weird things with maybe contributions weren't correct, or you need to correct somebody's earnings. But the vast majority are just staying on top of enrollments and terminations.
Right. And keep in mind that you can go in our system and terminate someone. We ask that you terminate someone within 30 days because other employers' enrollments may be contingent on your terminating those members. And then we know that you may not be able to terminate them in your system until all the money's paid, but you can report money up to a month after the term month.
Just checking the question queue. All right, so no questions. We're going to proceed to Index 6. And this is going to go over, certifying service credit, questionable years, different types of online corrections you can do.
Yes.
So in Index 4, we went over some definitions. Well, let's go over some more definitions.
Right.
First one, just a questionable year. That's just a fiscal year record that meets our criteria that requires certification. So actual earnings, we spoke about that with the monthly file, what somebody was actually paid for that month. But now we're talking about it on a
yearly basis.
Yeah, fiscal year basis. So what they were actually paid, all earnings that met the definition of earnable comp from July 1st to June 30th, fiscal year basis. And then full-time earnings, we mentioned on a
monthly basis. But for a yearly basis, the full-time earnings are going to be everything that member could have earned during the full working fiscal year. And just keep in mind if they had any extra earnings. I know sometimes, a lot of agencies don't have that, but if they do, it's normally their yearly salary for the fiscal year plus all extra earnings.
Right, just think of it, actual earnings, what they actually were paid, full-time earnings, what they would have been paid had they worked the full working year.
Yes, at 100% effort.
And then service credit, that's just how we measure actually how long a member has worked in our system.
Right.
There's a formula for determining service credit.
Yes. And so that formula is that our system is going to take the actual earnings divided by the full-time earnings, and that's going to give us the service credit for benefit computation. And that amount is what's going to be used to calculate a member's benefit at retirement. And then we can take that service credit for benefit computation, and we're going to divide it by percent effort if someone is working part-time percent effort. And then that's going to give us service credit for eligibility.
And so service credit is really twofold.
Right.
Service credit for benefit computation, that's what we use to calculate somebody's benefit. Service credit for eligibility tells us when they're eligible to retire and get that benefit.
Yes. Yeah.
And you mentioned percent effort.
Right. So if someone's working percent effort, that means, and there's kind of a little bitty difference between, somebody working part-time, like 3 days a week, or somebody working as needed. But if somebody is working at percent effort, that means that they are working every day of the contract, but less than the full day. For example, if someone's working 5 hours every day, but a normal work day for a full-time person is 8 hours, then that person is working at 63% effort. You're going to take that 5 hours they're working, divide it by the full day, and get that 63%.
So in this example, if somebody worked that schedule for the entire year, July 1st to June 30th, they worked the whole year at 63% effort. At the end of the year, we'd expect their service credit for benefit computation to be 63, and service credit for eligibility as a full year.
Right, and that's something that we'll talk about in just a minute, because you are going to have to let us know that they're at percent effort so that on our end, we can update the eligibility credit.
All right, so I guess zooming out, each month they're submitting a salary file to us. At the end of the year, we take all those, the data that was submitted to us during the year, and that gets posted to their account history as, their record for that individual year.
Right.
And some of those years have to be certified.
Yes, some of them do.
How do they identify what years need to be certified?
Right. So you're going to go to the reports tab. You're going to click on questionable years, and it's going to come up with this screen where you can select how you want to pull that questionable year report. You can either pull it retirement actions pending. You can pull all of your questionable years. You can pull them by less than or equal to 3 years old, or any year greater than 3 years old. You can pull it by fiscal year. You can pull it by 1 fiscal year, multiple fiscal years. And then after you decide how you want to pull it, then you can sort it in 4 different ways, either SSN order, fiscal year order, member status order, or reason code. Just keep in mind that if you're pulling the any kind of way other than retirement actions pending, when that report populates, the first page or pages is going to be all of your retirement actions pending. And that just means there's something going on in the member's file. It doesn't mean they're retiring. It just means that we've requested something of you.
Right. So that's always going to be at the front.
Yes. So if you pull the report and it's 1 or 2 people on the first page and you're like, that's it, keep scrolling, and then on the further down on other pages, you'll see all of the other ones.
Yeah, so this is just an example of a questionable year report. Again, in this environment, we're not going to show names and socials, but if you pull it for yourself, you'll see the names and socials. It's just a list of all the years that require certification. And keep in mind that questionable years, you're never really going to be finished.
Right. It's an ongoing process year to year.
You might finish it, get down to zero remaining, but then the next year there's going to be a whole new batch. So every year there's a new batch of questionable years. You want to pull this report multiple times during the year. It's going to list, it said name, social, the fiscal year being that's requires certification. It's going to show the date of employment, date of termination if there is one. It's going to list their actual full-time earnings and service credit, and then the reason that the year is questionable. So let's go over why a year is questionable. So the first reason is there's a salary decrease of more than 5% from the previous year. We're not typically expecting salaries to decrease. We're expecting them to increase. So if we see a decrease, we need to figure out, is this correct? Is the service credit correct? First year of employment, including first year after drop. Everybody's first year of employment is questionable no matter what. Same thing with their last year of employment. If there's a termination date, that's going to be a questionable year. And if the service credit is anything other than a full year, so 1.00, anything else is going to be questionable.
Right. And so you want to be pulling this report periodically throughout the year and clearing these. And you want to avoid, make sure you're clearing these years before they become 3 years old. And we'll discuss why in a minute.
Okay, say that you've generated your report, you've identified what you need to certify, and now you got to figure out, okay, how do I certify them?
Right. So you're going to go under the Updates tab, and you're going to either clear them by using full-time only correction, prior year salary correction, or questionable year certification. Those are the 3 ways that you're going to clear a questionable year. Most commonly used is the full-time only correction, and that's going to be when either the full-time earnings are not correct or the service credit is not correct. Make sure that when you're using this, keep in mind, sometimes the full-time rate is correct, but the service credit is not. So you will be able to use this when you're typing in the same full-time rate, and it's going to update the service credit.
Right. Then questionable year certification, that's probably the least commonly used because everything has to be right.
Yes.
You're not changing anything. You're just telling us that, hey, what was reported is correct. And then prior salary correction, that's when you need to change the actual earnings.
Right.
So let's take a closer look at these. So full-time only corrections, as you said, you're changing the full-time amount. You're going to type in the full-time earnings, the correct full-time earnings in the box down here at the bottom. And then you're going to choose a reason or a comment.
So if you were looking to certify just a normal average year, like first year of employment, last year of employment, everything is pretty reasonable. It's nothing out of the ordinary. Then you're going to select the reason. If there is something out of the ordinary, workers' comp or leave without pay or extra earnings or just something out of the ordinary, type of comment to let us know what's going on. The more you let us know on the front end, the less we have to go back and forth in emails to get on the back end. And again, you can put a reason and a comment, but you have to put at least one or the other before you can hit submit.
Yeah, just keep in mind that if you're doing a full-time correction, we're expecting you to enter the full-time amount for that whole year.
Right.
Just for the part of the year that they actually worked.
Mm-hmm.
So here's an example of a questionable year that needs a full-time correction to be certified. So this example, the person started October 1st, 2020. We see the actual earnings, the full-time earnings, they're really close to each other. We got 38,898 versus 39,125 for the full-time. Service credit posted at 77%. It's questionable because it's a first year of employment and a partial year service credit.
Right.
So if we just kind of look at the date of employment, in this case, October 1st, 2020, just from doing so many of these, we know that that's going to be around 80%.
Mm-hmm.
So 77%, we're starting with a number that's pretty good.
Mm-hmm.
But if we divide the actual by full-time, that's not going to give us the 77.
No.
That's going to be,
Because we can see obviously that the full-time rate is not correct.
yeah.
And I do want to add, when you're pulling this report and you're seeing numbers on there, the full-time earnings or service credit, that's all contingent on how you did the enrollment or termination or the months of contract. So don't always assume that everything on this report is exact or correct or in the ballpark. It's based on what you have in your records that you're certifying this.
Right. So in this example, we know those full-time earnings aren't right.
Right.
Yeah, that's not going to be a full year's worth for starting on that date. They're not going to get 99% service credit.
Right.
So in this example, the employer went through the records and said, okay, if they worked the full year, they would have earned this 50,155.
Mm-hmm.
But that's what they're going to enter as the full-time. We were to divide that out, actual by full-time, to give us, I think, 78%, which is, again, right in that ballpark of what we're expecting.
Right.
In this case, the reason would be enough. They don't have to put a comment because the service credit is what we're expecting it to be, so we don't need any other explanation.
Right.
If the service credit was coming out to something different than what we're expecting,
Right.
That's when we'd want to use that comment to tell us, basically, why isn't it what we think it's going to be?
Right. If it's a whole lot less, you want to put like dockage, leave without pay, or maternity leave, something in there. And if it's a lot higher than we're expecting, you want to put like extra earnings or some reason for it.
Right. So most questionable years are some combination of partial year service credit, first year, last year. So those are the things that we're looking at. Before we even see the correction, we have an idea of what we think it should be.
Right.
And that's what we're asking employers to kind of consider as well before they submit the correction. And this person worked this half the year, the correction shouldn't give them a full year.
Right.
Right. So you kind of always have that in the back of your head of, okay, what's the result of this number that I'm entering?
Right. Before you hit submit, even if you have to calculate it, using the calculator, before you submit it and it be unreasonable.
Right. Because if it's unreasonable and there's no explanation for it, we're going to have to question it.
Right.
So if there is an explanation, use that comment and tell us. And sometimes that's sufficient. It just depends case by case. But if we get a number for service credit that's way off, there's no explanation, we're gonna have to question it.
Right. Right. And before you submit it, if you have questions or you're not sure of what's going on with it and you need some assistance or you just want to, bounce some questions off of us, please reach out to us. We're here for you.
So we've both, over the years, looked at a lot of
Yes.
Corrections employers have submitted, and let's talk about some common things that we see wrong.
Yeah, one of the most common is like we discussed is using just the salary to certify a year when there was some extra earnings. For example, if that person had overtime or lump sum payments or extra stipend, what other kind of extra earnings besides the salary? You want to make sure that it is including everything that they could have earned. And again, you want to make sure that the actual and the full-time, they're not the same amount unless that person worked the entire fiscal year at 100% effort.
Right. Another one that we see sometimes is employers think they have to change the full-time.
Right.
If maybe the service credit is incorrect, but the full-time earnings are correct. in that case, you can enter the same full-time amount that's there. You don't have to change it by a penny or a dollar.
Right.
Enter the same amount, it's going to recalculate that service credit. We don't see this as much as we used to, but we still see it some.
Yes.
You can enter the same full-time amount that's there.
Yeah. Because sometimes, I mean, our system, it works on, a broad spectrum. So, for someone who's starting at your agency, our system may have said, they're only supposed to get for that time frame 98%, and you've got 60,000 out of 60,000 posted, and you're like, oh gosh, why didn't it give it a full year? Like I said, it's estimating service credit based on a lot of contingents. And so if you just type in 60,000 again, that's okay, and then it's going to update that service credit from 98 to a full year.
Another thing we see is somebody's rate of pay can change during the year.
Yes.
They start at one rate of pay, maybe they get a raise or change positions during the year, and then go to a different rate of pay. If they work the full year, then their actual full-time should be the same amount.
Right.
If they have some leave without pay or they don't start at the very beginning of the year, when you go to certify it, don't just put what the full-time rate was at the end of the year.
Right.
You're going to shortchange them on service credit.
Right. You're going to have to prorate it. And if you have questions on how to prorate someone that didn't work the full year, and you need to know, how do you enter that, just call us and we'll work you through that.
So we were talking about the reason and the comment, and you mentioned earlier about, part-time employees working at a percent effort.
Right.
If you're certifying somebody that is a part-time employee that's working at less than 100% effort, select part-time employee as the reason, and the comment tell us the percent effort. So again, percent effort is hours worked divided by hours worked per day divided by hours considered a full day. So if 8 hours is a full day and somebody is scheduled to work 6 hours a day, that'd be 75% effort.
Right. So if you select on part-time employee, that's going to automatically generate a work object for us so that we know to go in and look at that. And again, like I stated earlier, if you put part-time and then you put the percent effort, we're going to go in and we're going to divide the service credit by that percent effort, and we're going to give that member extra eligibility credit. We have to do that on our end. Now, if you do have someone working part-time and they're not on a schedule, they're just working as needed, or if they're working, 2 days or 3 days a week, you can put part-time, but you want to put in the comment, worked as needed or worked 3 days a week, something like that. So if they're not percent effort, tell us that they're not.
Right. Just use that comment to give us
Yes.
as much information as you can so that we can figure out what's going on.
Exactly.
All right, so when doing full-time corrections, you got to be aware that there's a statute that says any correction for a year over 3 years old that increases service credit is given actuarial cost to the employer.
Yes.
So right now we're in fiscal year 2026. So you can correct fiscal year 2025, 2024, and 2023 without any type of actuarial cost. But once you get, break that line of over 3 years old, which right now that would be 2022 and prior, if you do a full-time correction that increases their service credit, that's going to be an actual cost.
Right. And that's why we give you an option to pull those years on the questionable year report as less than or equal to 3 years old so that you can pull that up and you can clear it. The year that you want to be clearing right now is fiscal year 23, because June 30th, 2026, fiscal year 23 will become 3 years old.
So for these corrections that result in costs, we really have two methods of working them. We do an annual project. At the end of each fiscal year, we generate a report that has all the full-time corrections submitted by each employer during that year for years over 3 years old. We go through it, identify the ones that increase service credit. We charge you on an annual basis for those. We send out letters typically in November with a list of the corrections you submitted for each of your employees, how much the service credit changed for that person, and what the charge was for each individual correction. We include a copy of the journal entry with that. So that's an annual process. Typically, you're notified of that in November. There's a much smaller subset that we can work during the year. These are corrections that you submit, for years over 3 years old, and that person has a retirement application on file other than a drop-in application. And for those, we work them once their retirement benefit is finalized. We can work those in-house. So those you kind of just charge one by one, as we finalize them.
Mhm.
But the vast majority are part of that annual project.
Right.
So that was full-time corrections. That was one method of certifying questionable years. Another method is the questionable year certification. So like I said, this is probably the least used
Right.
because everything has to be right.
Right. So this is typically going to be when first year of employment or first year of employment after drop, they may have worked the full year. Everything is correct, but like Jeff said, it has to be certified. And so if it is correct on the full-time, actual, the service credit, everything is correct. You're not going to have to enter any amount. You just have to put a reason and or a comment to submit that. The other time you may see this is when somebody's salary drops below 5% than the previous year. It may be correct, but you want to put in the comment why that salary dropped. It could be that they changed positions, they got less extra earnings, something happened that their salary dropped. So you want to make sure that if that year is correct, use the certification and let us know why it dropped.
Right. And then the same stuff we said about using that reason and comment for
Mhm.
part-time employees working at less than 100% effort. That applies to this type of correction as well.
Right. And you want to put those comments in. And I don't know if I said earlier, it's important for people who are working at percent effort to let us know because they get extra eligibility credit. But the people who are just working part-time as needed or a couple of days a week, those people do not get extra eligibility credit.
But here's an example of a questionable year that can be certified via the questionable year certification. This example, this person was hired as of July 1st, 2020. The year in question is fiscal year 2021. The actual earnings and full-time earnings are identical. They're both 58,406.14.
Mm-hmm.
They have a full year service credit, and it's only being questioned because it's their first year of employment.
Right.
So everything's right. Actual earnings, full-time earnings, service credit. You're not changing anything. You're just telling us, no, this is correct.
Right. And it is reasonable.
So here's what that screen's going to look like when you select questionable year certification. You enter the person's social.
Mm-hmm.
It's going to show you, okay, here's what the record is now, the actual earnings, full-time earnings, and service credit. And as you mentioned, you're not entering any numbers here.
Right.
You're not changing anything. You're just telling us why you're certifying it.
Yeah.
So this one, first year of employment. We don't need any other details for this one, so there's no need to add a comment. Just select the reason and certify it. And the last method for certifying a questionable year would be a prior salary correction.
Mm-hmm.
So full-time correction, you're just changing the full-time earnings. Questionable year certification, you're saying, nope, everything's correct. For this one, you're changing the actual earnings.
Right.
And this is really a two-part correction
Mm-hmm.
because you're changing the actual earnings, but you're also telling us the full-time earnings.
Right.
So if you give us the correct actual earnings, but don't give us the right full-time, they're just going to create another problem.
Right. So it's not like you have to go in here and submit this one and then later do a full-time only correction. You're doing them both at the same time. So before you pull up a prior year salary correction, make sure that you have the full-time correction in hand so that when you submit the correct earnings, actual earnings, you're putting in the correct full-time. We don't typically see where you're changing the actual without changing the full-time. And just keep in mind, again, the actual and the full-time should not be the same unless that person worked the full year at 100% effort.
Right. And just a reminder, we're on a fiscal year basis, so we're
Mhm.
up from July 1st to June 30th.
Yes,
So these are going to require a reason and a comment.
as well.
Right. So I think it's a twofold correction. You're
Mhm.
doing actual and full-time. So it's going to need a reason or a comment for the actual earnings, as well as a reason or comment for the full-time earnings.
Right.
And there's a couple other things you can do with this program as
Mhm.
well. What if you've reported somebody that shouldn't have?
Right. If you, like, somebody wasn't eligible and they were in the system and you need to back them out and they shouldn't have any earnings for that fiscal year, you, beside the earnings, you can click on the box that says delete posting, and that will delete the whole amount of money.
Right. And then if you've reported somebody, maybe they had a combination of sheltered and unsheltered, and you've reported all as sheltered. You
Right.
need to add unsheltered. You can click that little add unsheltered box, and you can add the unsheltered amounts.
Right.
And if you need to switch all of the contributions from sheltered to unsheltered, vice versa. There's a 100% switch button you can select, and that's going to change it from sheltered to unsheltered or vice versa.
Right.
In that same 3-year time frame for actuarial costs that applies to full-time corrections, applies to prior year corrections as well. So again, we're in 2026. You can do 2025, 2024, and 2023 without an actuarial cost. But remember, if you're doing a prior salary correction, you're changing the earnings and contributions. So if you're increasing them, you're still going to have to pay those member and employer contributions. But if it's less than 3 years old, you're paying interest at the judicial rate instead of the actuarial rate.
Right.
If it's for a year more than 3 years old, well, then you're going to be charged the higher of the actuarial cost of the increase in service credit or the member employer contributions plus interest at the actuarial rate.
Right.
And if it has to go to the actuary to determine the actuarial cost, that requires a $200 fee.
Mm-hmm.
We're going to request that from you, and we can't proceed with that cost until we get that fee.
Right.
And these, you're going to receive a separate journal entry invoice for each charge. So this isn't an annual process like the full-time corrections. These are just as they come in, we work them and then charge the employers.
Right.
So you can go to your journal entry screen to see these charges.
Right.
But when you do a salary correction, if you're wondering, okay, what did this end up costing?
Right. So you can go under the employers tab and you're going to click on journal entry, and it's going to come up by, you're going to pull the fiscal year. And this is kind of opposite of contribution corrections. You're going to pull the fiscal year that you actually did the correction in. So if you pull 2026, it's going to pull all of the journal entries that you did for any year that you corrected during fiscal year 26.
Like we were talking about earlier about if you're an agency where OSIP submits your file, monthly file, they're also going to submit your payment. And You're saying, okay, if you do corrections, you're responsible for the corrections and the payment. So here's where you go to check your journal entries to see, okay, did this result in a charge or a credit, or maybe this one resulted in a charge, but this one resulted in a credit, and what's the balance?
Right.
Here you go to see basically the result of your corrections.
Right. And how you need to reconcile or pay a prior year balance.
Right. We check the queue for any questions for that section. Okay. If not, we're going to take a 1 or 2 minute break and come back and talk about the retirement process.
Okay.
All right, and we're back. And now Jennifer George has joined us to go over the retirement process, the employer's responsibility, during the retirement process. Okay. So when somebody applies for drop, they have different ways to do it. They can do it either by paper or through our member access system.
Right, that's for retirement and for drop.
Right.
They can turn in a paper or go online and do it. And for service, ILSV and drop.
So we encourage our members to coordinate the retirement date with their employer. Don't surprise your
please
employer. We don't want them to surprise you. We want you to be aware that they're retiring. Talk to the employer about insurance benefits, the annual leave payout.
Right.
That's something that they should be talking to their employers about.
Yeah, they want to definitely coordinate that. Once we receive an application, we're just going to send your employer and you an acknowledgement letter saying that an application has been received. But your insurance, annual leave, your date of retirement, all that should be coordinated through the employer.
Right. So I think this kind of differs from lasers. I mean, lasers tells their people to contact your employer's HR office to start that retirement process. But with us, they don't have to. They can come directly to us.
They can, yes. They don't have to go through their employer. We just encourage them.
We encourage
notify.
them to keep you in the loop. Like I said, we don't want you to be surprised to find out somebody's retiring and not be aware of it.
Right.
And when we do get an application for somebody, we do send the notification, right?
Right, yes. Once we get it, we'll send a acknowledgement letter to you stating what their date of retirement is and that we're going to need some certifications from you.
All right, so what do we need from the employer to get through that retirement process?
Right. So when a member wants to retire or enter drop, from the employer side, we need all of their questionable years certified. So you can go to their account history, see if they have any questionable years. We also need you to certify their sick leave, which is their sick leave used for the fiscal year, and sick leave days paid at retirement. We also need the agency certification, which is the Form 11B. This is something you turn in after their termination date and after all of their earnings have posted. We use this to determine if what their current year service credit is. So we'll take the actual earnings posted against the full time. That's why it's very important that you don't submit this until all earnings are posted.
So when we need something from the employer, we can send them request letters, right? There's a kind of a timetable for sending those.
Right. So this is an example of what the request letters look like to the right. It'll tell you if it's a first, second, or final. We usually, once we look through a file close to the member's date of retirement, we're going to send a first request for any missing information, usually an 11B or any possible sick leave. We will give you approximately 45 days to submit this information. If you haven't submitted it after 45 days, we're going to send a second request, and we will give you about 30 days to respond. At that point, we're going to send a final request. And in addition to sending you a letter, we're also going to probably call you on the phone, email you, and we're going to reach out to the member to let them know, something's missing from the file. After that final request goes out, if we don't receive what we need after 15 days, we can finalize the file missing the information.
And we want to give a heads up to employers about a change regarding what we require for legal documents.
Right. So this is not something that is required from an employer, but if you are helping your member out with the retirement process, it's important to note that if they're turning in a legal document, we can no longer accept copies, faxes, scans, emails. It has to be a certified original document. So if it is, say, a judgment of divorce, we need a certified copy that comes from the clerk of court with a raised seal. If it's a power of attorney, it needs to be the original notarized power of attorney, or it could be a true copy that is re-notarized by the original notary who notarized the document. And any questions regarding that should probably be funneled to our legal department.
Yeah, you mentioned another thing that we need as part of that retirement process is the agency certification, also known as a Form 11B. Where do they go to find that, and what is it?
So they can submit a Form 11B through the Updates tab. This, once again, certifies the member's current year service credit. So when a member retires or enters drop, we need the Form 11B. It's going to give us the termination date. So that'll be the last date the member worked. And it's also going to ask you for the full-time earnings. This is the earnings that they would have been paid had they worked the full year. Once we get this form, we will take the actual earnings that are posted through EMIS, divided by the full-time report, and that'll be their current year service credit. So again, it's very important that this is not submitted until after the termination date has passed and all earnings have posted.
I want to go back. Somebody's asking a question about the legal documents.
Okay.
If the member wants a legal document back, can it be returned to them?
Yes. That is, if the member is insistent that they want their original back, they would need to give us the original. We will make a copy, and in-house, we will state it is a copy from a certified original, and we will give the original back. Ideally, we want the original, but if the member is insistent, they can get it back.
All right, so getting back to the agency certification, the Form 11B, if somebody's retiring after drop, is there an extra step that's needed for those?
Right. So members who work after drop, if they work at least 3 years, they are eligible for a after drop final average comp recalculation. So if your member has worked at least 2 years after drop, we need you to fill out the bottom portion, and it's going to ask you for the member's last full fiscal year in drop, their actual earnings, and their full time. And we need this information to determine if there's going to be a cap in their final average comp.
All right, so sometimes we get questions about termination date versus retirement date. Can they ever be the same date?
No, they can never be the same date. So the termination date is your last day of work or the last day of official leave. The retirement date is the following date. So if your last day of work is June 30th, your retirement date is July 1st. The only time it could be possibly different is if we receive the application late, and it'll be the day after we get the application, if it's after the term date.
Right, so when they're filling out that Form 11B agency certification, they're putting the
The
termination.
termination date, which is the member's last day of work, that is the termination date. We will then retire them the following day.
Another thing that you mentioned was required was sick leave.
So we need sick leave reported for all fiscal years the member worked, including drop years. We also need the sick leave days paid at retirement. Usually it's 25 days, and you can provide all this information through the updates tab in EMIS.
So in that you had to go to EMIS, they click that sick leave, add, enter, update. That's where they're going to go to enter this.
Right. So if you go to the sick leave add, enter, update, you can enter the sick leave manually. So what we need to know is the months of contract. So 9, 10, 11, or 12. It's important to remember you're entering it based on the fiscal year, which is July 1 through June 30th. So after you do the months of contract, we need to know the number of sick leave days used for that fiscal year. And then,
Well, for most state agencies, OSIP or DOA is submitting annual sick leave file. But for back years, there could be years, before they start submitting that file, they have to enter manually.
Right. So this is all for manual entries. We need the months of contract, the number of sick leave days used. And that's not balances left over, it's sick leave days used.
And if somebody participated in drop, they're going to have to, might be a little tricky entering those days.
Right. So when members participate in drop, they're not earning service credits, so there's no sequence line for them. So in order to manually enter their drop sick leave, you would have to uncheck the use employment history box. This will allow you to enter the beginning and ending dates of drop. And once you've done that, then you can enter their sick leave for those fiscal years.
And then you said we needed, if they paid them any sick leave days at retirement, we need that as well.
Right. So that is used in their sick leave calculation if they paid them. Usually it's the 25 days, but we need it reported even if it is 0 days. We need to know for every member, did you pay them at retirement?
Right. And that's also done through EMIS, that updates tab. There's just the sick leave days paid update.
Right. It's right above the manual entry one.
If they want to view what's already been reported for somebody, they can do that as well, right?
Right. So you can always go check the sick leave annual leave tab. It'll show you all the fiscal years that they've reported sick leave has been reported, whatever the months of contract were, how many days they used, who sent the update, the date that it was sent, and down at the bottom, you'll be able to see if the sick leave days paid at retirement were submitted.
Let me see if there's any questions regarding the retirement process. If not, I just want to give employers a heads up that our member access program, which is what members use to view their records, look at documents, that's changing to My TRSL. That's in the next month or so. We're rebranding, roll out a new product. Member access is going to become My TRSL. It's going to be more functional, we think, for the members. We just kind of want to give you a heads up that this is coming. The member access, the current passwords and logins that they have will no longer work. They have to re-register for My TRSL. We're going to be rolling out more information to this in the next month or so. We just kind of wanted to take this opportunity to kind of let you know that it's coming. We're good, like I said, we're going to be rolling out some more stuff soon. Just want to let you know and that you can let your employees know that this change is coming. Right. We really reached the end of today's training, but I want to let you know that, obviously today we couldn't cover everything regarding TRSL. So if you need, customized training, one-on-one training, we offer that as well. Kelly Resnick is our trainer. Her contact information is right here on the slide. Contact her. She can set something up where you can come to us. She can come to you. We can do stuff over Zoom. We began today by saying that we recognize that you're much more familiar with lasers than with us. So if you need help on anything, just please don't hesitate to reach out to us. We're happy to help in any way that we can. Also, we're going to be sending out surveys shortly. Please take some time, give us some feedback on today's training. We're always looking to see what we can do to improve things and make it better. So at this point, do one last check for questions. And if there are no further questions, that will conclude today's training. Thank you for joining us today.